Hello and welcome to this special State of the Economy discussion. We have the all-important retail inflation for November being announced by the CSO, or rather the NSO, just a few minutes back, coming in at 5.48%. It's bang in line with the CNBC TV18 poll, and it has just crawled back under the Reserve Bank's tolerance band of 2% to 6%. However, food inflation still remains stubbornly high at 9.04%. No relief to the common man. In other news, of course, industrial output for the month of October has also come in. It's marginally higher at 3.5% compared to the September number. So that's a bit of a consolation. It's come at 3.5 on a high base. So not a bad number, I would say, though 3.5 per se doesn't look like a 7% economy by any standards. Let's get this analyzed by a band of experts. We have Indranil Pant, the Chief Economist of Yes Bank, Aditi Nayar, Chief Economist at ICRA, Devang Shah, Head of Fixed Income at Axis Mutual Fund, and Sameer Naran, the Head of Economics Research Group at ICICI Bank. Gentlemen, and Aditi, thank you very much indeed for your time. Let me start with you, Sameer. In line with expectation at 5.5 according to our poll, but are you confident that we are climbing down further towards the 4% decimal mark by the time we reach March?
Well, Lata, I think you're absolutely right when you started your, this discussion, and you pointed out that vegetable prices and food inflation is very stubborn. Even in this print, we were estimating a faster deceleration in vegetable prices, and actually the deceleration is less than that. So your point is very valid, and it perhaps will take slightly longer in terms of reaching the 4% target. We believe the RBI's estimate of reaching this number by Q2 of next year is perhaps the right trajectory. In between, the number remains around 4.5% in the March quarter, and the quarter after that, which is Q1 of the next financial year. So durable decline.
Q1, what is your estimate?
It's around about 4.5%, which is pretty much in line with where the RBI is. Yes.
And goes down to around 4% by the second quarter. Is that your estimate as well?
Yes, and for the next financial year, we believe inflation is averaging 4.3%. So it's very close to the target for the year.
All right. Indranil, would you agree with that? See, at the moment, this 5.5 is not a very controversial number. That's why I'm going to ask all of you your, 12-month ahead forecast. Is it going towards the 4.3% mark which the Reserve Bank has? Indranil?
Yeah, okay. I think most of what Sameer said is perfectly okay. And I think we were also expecting a lower number because the vegetables reflection from the NHB data to the actual data is much weaker than what we had expected. The second thing is that if I track the initial period of November, vegetable prices are just negative 3.4% compared to the negative 13.5% of the last month. And the climb down, especially in the winter month, is softer than in the previous year. So our next reading, taken all this into consideration, is still a 5.5%. And that really is coming from the food, which also Sameer did point out. Hence, in terms of the trajectory, yes, the trajectory is downward, but whether we get a sustainable sort of direction towards the 4% is the question. And in between, we'll also have to cross through inputs from the US side in terms of the tariff barriers and what it does to the global supply chain and the input prices. So these are some of the very sort of unknowns that we have with us. But if I leave those unknowns at this point in time, I would broadly even agree with Sameer's estimate of a 4.3 to 4.4 average for the next year, which is slightly higher than what the RBI points out.
Okay, so both of you expect that you are going to see a fall towards the 4.3% mark. The difference may be whether it will be 4.3 or 4.4, right? And Indranil, the other big takeaway from what you're saying is that if it is going to remain at 5.5 in December as well, then the Reserve Bank's third quarter number is also not going to be reached. I think they have 5.7. And now we already have 5.5 and 6.2. So unless we get something like 5.3 for December, we won't get an average of 5.7. So that also, and that number is important because that is the last number the governor has before he goes into the monetary policy in early February. So Aditi, that question to you. What does he go with? He has one 5.48, which is much better than 6.2. If he gets a 5.5, he's in a quandary in February. Your thoughts? What is the likely number for December and his likely state of mind in February?
So, Lata, so today's number headline, as we've all said, is in line with what we were expecting, but the climb down in food has not been as sharp as what we were hoping for. And if I look toward December, it's become quite cold in North India only in the last couple of days. So maybe part of that seasonal climb down in vegetable prices is ahead of us. So I'm a little more hopeful. While we've upped our forecast for December compared to what we had earlier, I do think we will get a further step down, or rather I'm hoping that we will get a further step down closer to around 5.1, 5.2 because of, the colder temperature which is only just set in, which hopefully will dampen vegetable prices going ahead.
What is the nowcast? Do you have the first 10 days vegetable prices? What is it indicating? Aditi?
So we are now working with 5.1% for the full month based on where we expect things to move in the rest of the month. For February, my sense is that if we get a number which is somewhere around the 5% mark, then perhaps we still have a chance for a rate cut in February itself. But if it's going to be closer to 550, then I certainly think we're going to get a delay to the April policy.
Oh, shucks. Okay. Well, we've been speaking with teams and teams of experts, ex-RBI guys like, Mahalingam, who I rate very highly as a regulator, both at RBI and at SEBI, and who has been on the dealing room of Reserve Bank. He says that finance ministry heads, when they come into Reserve Bank, for the first few months, they have their say, and afterwards they become RBI guys because the RBI bureaucracy is deep and learned and prevails upon them with their data. So you're right that if it is, if it is below 5.5, there is a falling trajectory. 6.2, 5.5 and 5.4 or 3. There is a reason. But Devang, two questions to you. First of all, how will the market react today, or rather tomorrow, especially the currency market? And what is your sense about February policy?
So thanks, Lata. I think probably the panel rightly highlighted, I think this month reading has been in line. We don't see too much of reaction because as bond markets are open, currency also I don't see significant depreciation or any major impact tomorrow. So from our perspective, I think bond markets would probably take it or trade in a very, very thin range. From our belief is that yes, I think, and most of the panelists, our view also is that first of all, next month print, I agree with Aditi more. I'll go with a 5% kind of a print, what our internal model says. And next year, we are more in that 4.3, 4.4% band. As the monetary policy is forward looking, we believe that February onwards, every policy is live for rate cuts, and we continue with the view of a 25 basis rate cut in February monetary policy.
Okay. Yes, if it is 5 or even if it is 5.4, I think the governor's job is slightly easier. It becomes tricky only if it is, the same as October or same as November, in which case the theory that it is going towards 4 will not be bought. And to be fair, isn't winter the time when we all wait for red carrots, 10 carrot halwa? Isn't it the time when we wait for cheaper tomatoes and tomato pickles? This has traditionally been, at least in our house, buy piece and store it for the full year, shell the piece and deep freeze it. None of that is happening, at least in my house, because it's still not quite there. And especially tomatoes, potatoes and onions, all of them ruling at 60 rupees is perhaps a new high as far as December is concerned. So Aditi, at the moment when I go to the market and buy vegetables, I'm not still in your camp, but that is a very anecdotal observation. Obviously not a scientific observation like you guys are making. The consensus now therefore is the rate cut. Let me get all 4 of you in. Devansha, rate cut in Feb?
Yes.
Aditi, rate cut?
If December CPI is around 5.1%, which is my current forecast, then yes.
Yeah, give me monosyllabic. Yes or no? What's the hunch? Yes. Well, because your guess is 5.1, you have more of a right to say yes, or at least basis. Samir?
Yes, I think Lata is also about growth. So when you put both together, I would say yes.
I'm getting there. I'm getting to the growth question with IIP. Point taken. Indranil?
I would have liked to answer like Aditi, but I would say a no at this point.
Okay. 3:1, that's good because after all, even the official MPC is divided on these matters. But there are already two doves there, so perhaps the governor has a little more support. The December number genuinely becomes important, and not just because of rate cut, but simply because we want to see vegetable prices down at 9% food inflation. And mind you, I have gone back 18 months from the July. If you remember the big July ugly number of 2023, which is what led to Reserve Bank's tightening, we got, I think, 7.8 or something. From that month onwards, we have seen food inflation. I wonder if we have the chart. We made up an 18-month chart of vegetable or food inflation earlier in the day. It's been ranging between 8 and 10%. And that brings us to the problem of growth. If that much money is taken away by inflation, then obviously urban consumption will be weak. So, Samir, would you believe that urban consumption has weakened? We have some anecdotal data from FMCG companies. What's your observation? What may be the growth for Q3?
So we believe October has been much better, Lata. Both festival sales, even passenger vehicle sales, SUVs, though driven by higher discounts, have been much better in the month of October. Even two-wheeler sales have continued. Recent HFIs like diesel sales also point out to a recovery in activity. So we believe that Q2 was an aberration. Higher government spending, higher, overall picking up of activity because there is no excessive rainfall that happened in the month of August and September. All of those factors put together make us believe that 6.5% is the growth number for Q3 and going forward into the next few quarters as well.
That means your full year number is not reaching 6.5.
No, it's 6.3.
Okay, fair enough. If you look at the IIP number, and now that, with this forum, to look at those numbers, the IIP number is not inspiring confidence, is it, Indranil? It's like 2.7, consumer non-durables. This is the month before Diwali, and the Dasara month. If that is the output of consumer non-durables, or of course you can question the data itself. Consumer durables up 5.9, that's a little more decent. Capex is still bad. Capital goods growing at 3.1%. 3.5 is not a very inspiring number for a pre-festival month of production. Your thoughts on growth in Q3?
No, I understand where you are coming from, but I am also sort of trying to struggle as to figure out what is happening to the growth perspective, given the fact that the CEA also points out that the numbers that we last saw is likely to be revised up. So you doubted the industrial output number. Now I tend to doubt the overall GDP numbers, and therefore my perspective in terms of what is the full employment or the right type of growth in the Indian economy is something I am really not confident about. The second thing is that you did talk about inflation pulling down the urban consumption, but my feeling also is that inflation is likely pulling down the rural consumption. So we have been hopeful of the rural consumption for a significant period of time. Yes, there has been some bit of an uptick in terms of the two-wheelers and the tractors. But beyond that, I am not sure whether rural consumption is doing any better. And given the fact that agriculture and non-agriculture real wage growth and also real urban wage growth is quite on the lower side, I have my doubts in terms of the private consumption picking up in the remaining part of the year. So that really leaves open the question as to whether the government is likely to ramp up or will be able to ramp up its expenditures. At the current run rate, they will possibly be able to manage a 4.6% fiscal deficit also, but that actually is negative for growth, and that is where my worry is.
Okay, well, we have to trust that they will be able to spend. At least that's their promise. I have promised a commercial break to the producers, so I have to take that. Coming back with a bunch of more questions to you all on both the growth and the inflation outlook. Back in a minute. Welcome back to this special State of the Economy show. We've been discussing the November consumer price inflation numbers, which have come in as expected at 5.5%, as also the October industrial output numbers, which again have come exactly as the CNBC TV18 poll said, at 3.5%. I've been speaking with Indranil Pan of Yes Bank, Aditi Nayar of ICRA, Devang Shah of Axis Mutual Fund, and Sameer Narang of ICICI Bank. Gentlemen, Aditi, thank you very much for your patience. Devang, while of course the December inflation number is crucial and we discussed that as how material it is for the February rate cut, even more material is the way in which the rupee is moving. What are the bond dealers talking about in that context? Do you think the governor can be that boldly dovish with a Trump who would have taken charge on Jan 20th? You're just a fortnight after that. So does that still give the bond market some jitters about how we can treat interest rates?
Well, surely that actually you have hit the nail quite hard, and you are right on that perspective is that the only worry which we see actually right now is rupee. I think monetary policies are always forward looking. So looking at the environment today on growth and inflation, RBI would have started to look at giving some guidance on rate cuts or might have started cutting rates also. But it is only for rupee that I think, and the currency that I think is stopping RBI from being dovish or cutting rates. As per us, what is the capital markets talking right now is two things. One, I think what is going to happen in the Fed meeting next week. They will be closely looking at, obviously the Fed rate cut is largely in prices, the 25 basis in December. But markets would be keenly watching what is the rate cut expectation next year. And secondly, post the Trump takes office, probably they would like across that what are the policies which they can announce. Why February as per us still makes a larger probability is because one, RBI would have gone through the budget. If budget continues with the fiscal consolidation path, that actually paves way for some bit of monetary easing. Secondly, I think the near-term hump on inflation will be done, and probably, as everyone is highlighting, we would get the closer to the 4.5 for next quarter. And third, I think some bit of Trump policies and dollar appreciation trade would be in prices. So that is why we believe Fed makes a lot of sense for RBI to start looking at rate cuts.
Okay. I guess everybody's probability, like in the Fed's case in February, also is a yes for a rate cut rather than a no. But I just wanted one more thing on inflation out of the way. Aditi, are you not worried about the edible oil prices? That also has risen 13%. We thought that the tariff hike on edible oil prices was already factored in October. It's poured on into November. And likewise, even if you looked at pulses prices, I mean, you're having a kind of a slightly widespread inflation. It's not just vegetable. Pulses, cereals and products are 6.8. That is almost 7%. And then you have oils and fats rising at 13%. And I also noted pulses have come down to 5.4. You think that would be a worry that other food prices are not falling, especially cereals?
Tata, you're quite right. In fact, before seeing today's data, we had penciled in 5% for December, and we have upped it after seeing today's data because food inflation hasn't fallen as fast as what we were expecting, even though the headline number has come in line. So worries are still there. By the time the February policy meeting comes around, we will have a lot more information, at least on the Rabi crop front. Hopefully that will be enough to give more comfort in terms of bringing the rate cut in February itself instead of pushing it forward into the future. Of course, there are some prints in the middle of the year that are going to look quite benign. Do we want to preempt the rate cut, saying that those are coming, or do we want to wait till those come and maybe the forward-looking prints at that point in time may not be as benign as what we might get in around Q2 of FY26. So I think that will be a call that perhaps the growth environment will also shape. As of now, I'm a little more enthused on the growth side, perhaps than some of the other panelists. We're tracking a number for the IIP growth for November, which is closer to 5 to 7%. The base effect was quite unfavorable for the October number, and as usual we have the shift in the festive calendar which makes analysis quite complicated during October and November. So we are looking forward to a better print in the month of November, and hopefully we will be able to pull off a 6.5% growth for the full year.
Okay. Well, point taken. We are coming to the end of the show, so let me do one rapid fire. I want all the economists to give me your GDP growth forecast for this and next year and your inflation forecast for this and next year, just by way of revision. Indranil, GDP for this year and next?
6.2 and 6.5.
Okay.
On the inflation.
Yeah, I'll just come for the inflation. Aditi, GDP?
6.5 each.
Okay, both years. Both years, right? FY25 and FY26. Samir?
6.3 and 6.6.
Okay, so they're in that range. What about inflation, Indranil?
4.8 and 4.3.
Okay, so 4.3 is something all of you are agreeing on. Aditi?
Yeah, roughly the same, 4.8 and 4.2 to 4.3.
Okay, and Samir?
Yes, a few basis points. I think we may get 4.7 this year and 4.3 next year.
Okay, you're being a little more dovish. Well, Devang, you should be happy that everyone's talking about 4.3, and that might be reason enough for the governor to at least give the first rate cut in February. But okay, I think I have time for one more rapid fire. How many rate cuts in this cycle? Indranil?
50 to 75.
Oh,
So 3.
not decided.
Max 3.
3. Okay.
Max 3.
Aditi? How many?
2, 50 basis points.
2. Okay. Devang?
2. 50
Okay.
basis.
2. So 50 in all. And Samir?
Shallow, 50.
Okay, so the majority is only 50 basis points. I don't know how much that will help growth. I think it will be much more if the government were to spend the money it has and the Reserve Bank actually does some OMO purchases. I think that will be a lot more relief, which they may do after all. Thank you very much, gentlemen and Aditi, for parsing the inflation and IIP numbers for us and giving us your growth forecast. That's it on this edition of the State of the Economy. Do stay tuned in. There's lots of news and analysis lined up for you on CNBC TV18.